After this latest CPI report this week, everybody is asking, will the Bank of Canada continue to raise rates? Now, there is an important interest rate announcement that is coming out in the beginning of September, but we're going to be breaking it down today to see which way the bank could be leaning. In this video, we are going to cover three things. The first is the latest CPI report. We'll do a breakdown of that. The second, we'll look at some economists and some analysts that are saying the Bank of Canada should pause. And then finally, we'll finish it off with one economist who thinks the Bank of Canada could potentially be going higher. And of course, I'll give my thoughts at the end, so stay tuned for that. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Let's get started by talking about the latest CPI report. If you didn't see the headlines, it did come in over what was expected, and we can jump over to this report to see that CPI rose 3.3% year over year in July. Now, I think it was anticipated to be around 3%, so it's a little bit shocking that it is coming in higher than our latest print at 2.8% for June. Now, if we take a look at all of the individual categories, gasoline prices were little changed. And this is something that is a very good sign. But if you've noticed lately at the pumps, we have been paying more. That's because oil prices have risen. So you could probably expect for August this number to increase a little bit. We also have overall energy prices down 8.1% from a year ago, which is really good. Food inflation dropped 7.8% in July from 8.3% in June, which is a very good sign. I know I went to the grocery store a couple days ago. I feel like I only bought like 9 or 10 items. It ended up being $100. I couldn't believe it. I still can't believe it. Hopefully we do start to see some deflationary efforts there. I don't know how that happens, but it almost seems like it's going to be a new norm. One of the items that stuck out like a sore thumb is the mortgage interest cost. Now, this did rise 30.6% at a year over year basis. And some trend that we've been seeing over the past 3 to 5 years with many new entrants into the housing market doing a variable rate mortgage. With the Bank of Canada raising those rates, they're also paying higher on their mortgages. Now, realistically, if the Bank of Canada does decide to go higher in September, we can expect this number to continue to rise. Now, if they're trying to combat inflation by also increasing the interest rates, knowing that homeowners are affected because they'll pay more in their mortgages, it's almost like a double-edged sword. We're going to get screwed. We're damned if we do, damned if we don't. One of the better sides of this report is that the Bank of Canada's preferred core measures, and this is designed to give a better gauge because it shows a shorter timeline, because we know that interest rate hikes do take longer to get an effect into the economy. It gives the Bank of Canada a better sense of what's happening recently instead of a year over year where inflation was at 6, 7, 8%. And this is showing slight improvements on an annualized average 3-month basis. So this is something that we can take as a positive out of the report, although there are some areas within the CPI report that are still increasing month over month, if not year over year. We've heard it before from the Bank of Canada, higher for longer. They anticipate that inflation is going to stay above 3% at least until 2025. So maybe they're taking this into consideration in the sense of not hiking next month because of the fact that it does take a while to get in. But let's read what the analysts are saying. So we'll jump over to this Global News article. And one economist is obviously stating the fact that we are expecting a long-awaited slowdown in the economy. We are expecting that households should cool spending demand and then turning into less pressure on inflation because we won't have so many people going out and spending on retail, etc. You're artificially slowing the economy that way. And this could offset the impact of the diminished base year effect and could help keep the annual inflation in the Bank of Canada's 1 to 3% range. So obviously what they're saying is with an economic slowdown in the fall, this could further reduce inflation and therefore could prevent any future hikes. They go on to note that the Bank of Canada will be looking more closely at its preferred core measures of inflation and shorter 3-month gauges of price momentum, which we mentioned before in the previous report, which did look good. And they believe that signs of easing in the labor market and other aspects of the economy will be sufficient enough to keep the Bank of Canada on the sidelines. And not only for the next report in September, but they're saying for the rest of the year. However, with that being said, core inflation measures have been sticky. And if they show signs of flaring up, the Bank of Canada has made a note in the past that they are not afraid to continue to raise rates. The Bank of Canada's goal is a sticky one. They have to keep that inflation within range, so between 1 to 3%. They also have to protect the economy. So we got some highlights from this article saying, hey, unemployment is coming in a little bit higher than what is expected. We should take that into consideration. But it's also noted that if there is anything that is persistent with inflation, we could expect the bank to act. But based on the data that we have today, this analyst believes the Bank of Canada is not going to make any decisions higher for the rest of the year. We'll take a look at another article here of somebody explaining what this latest CPI report does to the Bank of Canada's decision. And we can read the Bank of Canada had previously projected inflation to remain between 1 to 3% from the middle of 2023 for a year, and then creep down to 2% by mid-2025. So what does that mean? That means given the Bank of Canada has given itself a long time to reach that 2% inflation target, this likely will not be enough to get the central bankers off the sidelines. And that was Diego Figueiredo, an economist at Desjardins. Another economist went on to say they see it as a 50-50 proposition, whether they're going to hike or not. Although we tend to lean towards the hold given the softening job market. And that was Jules Boudreau, a senior economist at Mackenzie Investments. In summary, these two economists see that the Bank of Canada has given themselves time, therefore they're not going to make rash decisions in the short run. And then we also see the effects of the higher interest rates in terms of the softening job market to kind of let us know that they don't see a hike coming in September. One of the most interesting articles that I did come across is that Stephen Poloz, he's the ex-Bank of Canada's governor, aka Tiff Macklem's predecessor. He came on to say that he sees cracks in consumer resilience. The interest rate hikes are already taking an effect. So we'll read through this briefly. And the economist who led the central bank from 2013 to 2020 said the country's stronger than expected growth in the first half of the year was driven by population increases and the resolution of a unique supply chain shock from the pandemic. An early jump in household spending was likely a mirage, he said, driven by savings built up during the lockdowns. The article goes on to show a chart here which states the consumers haven't fully recovered in Canada, and it shows the household consumption expenditure in the white line and what the pre-pandemic trend was. And we can see that although the economy has rebuilt itself back up until now, we haven't really caught up to where we were before. So that's something that is definitely something to take into consideration, because we've seen the employment market is softening. We've seen now that the consumer is definitely weakening. In other reports, we've seen credit card debt has definitely increased in the past year. So what they're trying to say here is just hold off. I know you're playing a difficult job in terms of making sure inflation is tamed, but also making sure the economy is safe. I think what Poloz is saying here is that we're in a wait and see period still. Now that we've covered the economists that don't see a hike in September, let's take a look at what some economists are saying that think the Bank of Canada could potentially hike in September. So we'll jump over to this Financial Post article and we read Douglas Porter of BMO. There's no sense in sugarcoating this one. It is not a good report for the Bank of Canada. Consumer prices rose 0.6% in July, pushing the headline to 3.3%, a big come down from June when the reading was 2.8%. While a modest uptick had been expected, Tuesday's data blew the doors off economists' forecasts. And that was Randall Bartlett from the Senior Director of Economics at Desjardins. It also pushed Canada's inflation higher than the US for the first time since before the pandemic. With that being said, Bartlett did go on to say that he argues that key measures that the Bank of Canada looks at did show signs of improvement. The preferred CPI median and trim median slowed slightly, and its newest measure of core inflation, which excludes shelter, fell 4.2% annualized. So the modest, slow-growing core CPI is a thin silver lining, but that is not what everybody is saying. The fact of the matter for Douglas is that the inflation figures will make it a tougher call. One of the main reasons that the bank did begin hiking at the beginning of summer was because of a bump up in April's inflation. While the majority of economists expect the central bank to hold at 5%, there are some in the hike camp. CIBC economists see a final 25 basis point hike in September. Derek Holt, who's the head of Scotia Capital Markets Economics, warns that the Bank of Canada is at a high risk of losing the fight, needs to crush inflation with more hikes. If the Bank of Canada waits for the lagged effects, then it faces the high risk of losing as wages and expectations get out of hand. So we have a couple economists saying here is that if you don't nip this problem in the bud today, it will continue to persist. Now, the reality is that the Bank of Canada has a very difficult decision coming up on September the 6th. Now, it is important to note that we do get a very important data set on September the 1st. That is what our second quarter GDP has been. And if that shows signs of significant weakness, which many predicting will be, then I cannot see a way that the Bank of Canada does move higher. Now, I'm not a crystal ball. I don't have a way into the future. This is just my thought as to what's going to happen. But I think we're definitely not going to move higher in September. I think we're still in a wait and see pattern. And based on the fact that the mortgage interest costs have increased so much, it's impacting so many different people. It's impacting many homeowners, and it's very unfortunate, but just a fact of the situation. We also have the job market starting to slow, unemployment's moving higher. It'd be very hard to see the Bank of Canada continue to go higher. The lower inflation will happen. They've set their timeline to 2025. No need for rash decisions in the short run. Let's see what this GDP comes out with. Let's see what some numbers come out with. If we need to hike again, let's revisit in 2024. But again, I'm just a guy here on YouTube. I am not the professionals in that money bracket making all the decisions. But let me know your thoughts down below. Can you see the Bank of Canada moving higher, or are we going to hold on September 6th? Let me know down below. If you enjoyed this video, we cover Bank of Canada content all the time. Make sure to check out some of the videos that I've done before. I'll link a few right here. I hope you enjoyed the video. I hope you all have a great week in the markets. Happy investing.